Happy Friday, folks. So in today's video, we're going to talk about is how robust the economy is, how the employment numbers are so great, manufacturing's awesome, and this is why the Federal Reserve is saying we got to keep raising rates because the economy is just way too good. If you found sarcasm in my verbiage, you did. So in today's video, what we're going to talk about is the economy truly as strong as the Fed's saying it is, or is the job numbers as strong as it is? There is one piece of this puzzle that I keep saying, and a lot of people are saying, not really, but let's get over and ask a friend of mine, Rick Santelli, what he thinks. What's the problem, or why are we in this position that we're in right now? So without further ado, Rick, answer this question for us.
Listening to our two guests, all I could think about is that one of the biggest reasons why interest rates are going up is because the government spends ambitiously, and they continue to spend ambitiously. I think this is a big deal, and we need.
So the government spends way too much money. That's why we're in this dilemma, and I can't disagree with the guy. This is one of those reasons why I'm a proponent is they shouldn't give student loan forgiveness. That's another how many $1 billion that's going to add to the fuel to the fire when it comes to the government debt. And I made a comment about a couple weeks ago, and it wasn't intended to come out this way. So here's the comment I made. Is I was talking about the national debt, and I made a comment about Ukraine, how we just agreed to pay them another $6 billion. So that was a little off cuff, and I apologize to anybody out there that might have took offense to that. My whole goal here is just to say, government, you guys are spending way too much money, and we don't have the money. So all the news you're going to see this week and for the next 2 or 3 weeks is federal government now hitting another roadblock when it comes to the national debt, because our national debt is coming to a head again by the end of this month. And if they don't pass any more legislation to increase the national debt limits, we're going to have another debacle. It was funny. Last night I was talking to one of my sons. He's 30 years old. And he said, you know what, every time there's an election year and every time this, my generation's starting to see, how the political, pondering works. And I said, okay, that's fantastic. But now look at me. I'm 58 years old. I've been seeing this 2 times as much as you guys have been seeing it. So please take my word for it, guys. A lot of this stuff is pondering. A lot of this is just, they want to point the fingers at the other party. But the problem here is we have a national debt crisis that's out of control. And the next bubble to burst is the student loan payments. They have to fix this problem. They just can't forgive it, which I get what you guys are saying. It will help a lot of people. It will, but you're not fixing the problem. It's like having cancer and putting a Band-Aid, over your arm. It doesn't fix it. It doesn't even really do anything. It just maybe looks good, but that's about it. So let's get over to the economic data that we have today, because on my channel, what I try to do on a daily basis is inform and educate you guys. The economic data that we're having right now, how's that affecting real estate and the housing market? That's what we concentrate on this channel. The reason being is I'm a mortgage advisor, have been doing it for over 30 years. I'm licensed in every state in the country as well as Puerto Rico. So let's get over to some of the things that we're focusing in on today. So the first thing we want to see is the bond market. The bond market is doing actually okay right now. But the one area that I want to focus in on is the economic data that came in this week. One of the numbers that came in this week was the manufacturing index. Okay, so I want to just show you the economic calendar. Here's what it looks like for the week. We had building permits. They were up a little bit from where we expected. Crude oil, I really don't focus in on that. Federal Reserve held rates at 5.5%. And then we have initial jobless claims. The Fed saying, well, the jobs market is really robust. Well, I'm going to have to counter on that one a little bit. And then manufacturing. Here's manufacturing, okay? What I want to explain to this is the number that just came in is negative 13. It was positive 12 previously. Okay, what is this index? Well, if you read the definition down below, it's the Philadelphia Fed Reserve Manufacturing Index measures the relative level of business conditions amongst manufacturings in the Federal Reserve's district. A level above 0 on the index indicates improving conditions. Below indicates worsening conditions. Okay, so we went from 12, which is way above 0, to now negative 13, that's way below 0. Okay, so this is where the manufacturing numbers are right now. Do you think that's robust? The economy's cranking on all levels? Okay, the next thing we want to do is here's job numbers. Okay, this is actually from the Federal Reserve. Okay, you go down through here. Here's how many jobs, how many people have jobs. So you go across this, and by the time people lose their jobs, retire, get new jobs, change jobs and everything, look at the jobs market, how flat it's been for a long time. Okay, since 2013, this is where we've been. Then you go through, and then we hit the pandemic. You can prove that down through here. In the pandemic, this is how many people lost their jobs in that time frame. Okay, that amount of people have not. It hasn't even added back up yet. But here's the jobs market. We had a ton of people go back to work, and then it's back to square one again. So we're back to levels that we've seen in the last 10 or 20 years. So we have a crumbling manufacturing index. We have the jobs market that's basically just flatlined. I don't really see a huge amount of data here that the Federal Reserve is looking at saying that the economy is cranking on all levels. The problem that we have is the federal government keeps pumping out all this money, spending money they don't have. And there's still a lot of people that still have, built up savings accounts from the last couple years that they're still depleting, and they're depleting it really, really fast. Now, on the other side of the spectrum, I want to show you guys what's going on with housing. I've been a proponent that the housing market is not going to crash in values, but the number of units sold is basically, I think, the lowest in history. But here's what we're seeing. Existing home sales hit 7-month low as prices keep rising. So remember a lot of other channels and mainstream media, they're like, oh, the housing market's going to get clobbered. You're going to see house prices dropping below 2010 levels. You're going to see some areas dropping 50, 60%. And my question to them is, why? Why? Usually to have a price of something, anything, a widget, bananas, cars, you have to have too much of something. Okay, so we don't have too much housing, because right now, if you have a house valued at $300,000 or less, check your realtors in your area. Ask them how long that house is sitting there. $300,000 and less, you're going to have a competitive, competing war on that house. You're going to get tons of offers on that house. Believe it or not, we're still getting probably between 20 and 30 consultations a day, people looking to buy real estate. I'm not saying that to kind of fluff this market. I'm just saying, guys, the housing market values are not crashing. They're not going to crash, and they haven't crashed. You have areas like Austin that's the biggest loser right now. It's down 10% year over year. Most markets are basically flatlined, as I expected. Okay, so that's what we're seeing here. So that hopefully is going to debunk a lot of people saying, housing market's going to crash and all this other stuff, because you can see right through here that the housing market is not crashing. I think I might have in August, unsold inventory 3.3 months supply. So we also look at inventory. We focus in on inventory. You have a seller's market when you have less than 6 months supply, and that's what we have right now. Meaning there's nothing out there. Now, when you get over a 6-month supply, that's when it's a buyer's market, because there's a lot of inventory out there. Okay, let's see. Existing home sales, single family, median home sales. Let's go down through here. I think I highlighted. Yep. The August median sales price of all existing homes was $407, up 3.9% from a year ago. Okay. And median existing condominiums, 354,000, up 6.2% from a year ago. Okay, so that explains to you guys there's not a housing crash. The market didn't crash, and it's not going to crash. Okay, so that's my expectations right there. Let's get over to the stock market to see, is the market starting to kind of settle down from yesterday's data from the Fed? We see through here, the Dow Jones is basically flat, NASDAQ is up 50, and the S&P is basically flat. Let's go over and check out what's going on with oil. Oil is up back to $91 a barrel. Why does this scare me? Because everything runs on oil. So I really focus in on oil as well as all the other dynamics in the economy, because the higher oil prices get, unfortunately, the higher that all costs are going to get for us. So based on this economic data, what's the bond market doing right now? So this is actually good news right now for the bond market, some of these numbers coming in, because a lot of people are looking at this like me. They're saying, okay, manufacturing numbers are bad. The jobs numbers are not so good. You got wage growth that's not there. I don't really see where the big silver lining is that the Federal Reserve's looking at to say, okay, things are still going really, really well. We got to continue to increase rates. So what you're seeing right here is the bond markets that I follow on a daily basis. Right over at the corner there, you're seeing the 10-year Treasury. On top of me, you're seeing the MBS market. What does the MBS stand for? It's basically a mortgage bond that trades on Wall Street. Okay, that's what I follow. I wouldn't follow the 10-year Treasury because it has really no direct correlation to mortgage rates, but the mortgage-backed security bond does. So what you're seeing on your screen right now is what's happening to the mortgage-backed security price. If you squint, you're going to see the prices are up 13 ticks right now. What that means, all you need to really know is if the bond prices or bond prices in general go down, rates are going to go up. We love this. Finally, we get a positive number. So it's up 13 ticks right now. We're going to come off the highs that we've seen. So where are mortgage rates today? Well, here's the top 6 products that people use when they're buying or refinancing a house. This number is just ticks away from a 52-week high. You're going to see that right here in the corner. So these are the top 6 products people use when they're buying or refinancing a property. So the criteria behind this is basically this. It's a first-time home buyer buying a primary home, and it's a single family home. It's not a duplex. It's not a 4-unit. It's a single family home. Okay. More criteria on this borrower is they have a 740 credit score and they're putting down 5%? No. 10%? No, they're putting down 20%. So you might look at these rates and say, Dan, my rate's a little bit higher than that. Well, you might not be putting down as much money. You might be, Dan, my rate's better than that. You know, I got a good deal. Well, you might have, but you might be putting down, or you might have a better credit score or something else. How do you find out if you're getting the best deal in town? Go over to therateupdate.com. That's my website. I'm a licensed mortgage advisor, licensed in all 50 states as well as Puerto Rico. Here's what I'd ask you to do. See at the top up there, about the 4th one over, it says loan estimate. What I need you to do is if you got a loan estimate from another company and you want to check to see, is that the best thing out there right now? Instead of you sitting there having to call, 10 or 15 different places, they want to pull your credit, they want to do that. It's going to completely mess you up and confuse you. What we can do for you for free was we're going to analyze that data. We're going to scan your loan estimate or your loan criteria with over 70 different lenders throughout the entire country to see if there's anything out there better for you. How do we do that and why do we do that? Well, like I said, I'm a mortgage advisor licensed in all 50 states. I have affiliations with over 70 different banks, credit unions, and mortgage companies to help you guys get the best rate out there. I can use their products and also their rate sheets to provide this service to you. But if you haven't started this process and you're like, I don't know if I can qualify or not, the one thing I always ask people is please do not disqualify yourself. What you could do is up there, it says the 3rd one in, it says apply now. The unique piece about that is when you click that button, it's going to give you some questions. Based on the answers to those questions, it's going to route you then to the specialist on my team who specializes in exactly what you're looking for. But if you're like, Dan, how do I just reach out to somebody right now? Or can I email you some questions that I have? Absolutely. Just go down to the bottom of my website and you're going to see that right here. You can give us a call, 844-775-5626, or you can email me directly at dan@therateupdate.com. Thanks so much for watching, guys. I hope you find value in this channel. If you do, please don't forget to subscribe down below, and I hope you have a fantastic weekend.